Accounting principles are the foundation of every financial decision. In this video, we'll explore 12 essential principles that every professional needs to understand. Let's dive in and make sense of the numbers.
The economic entity principle is a fundamental accounting rule. It requires a business's financial activities to be entirely separate from the personal finances of its owners or any other business. Why does this matter? Imagine trying to track a company's performance if its records were mixed with personal expenses, like groceries or vacations. It would be chaos. This principle ensures clarity. By keeping transactions distinct, accountants can accurately report and analyze a company's performance. It also avoids legal or tax complications from commingling funds. In short, the economic entity principle keeps the focus on the business itself, giving stakeholders a clear picture of its financial health. The going concern principle is a fundamental concept in accounting. It assumes that a business will continue its operations into the foreseeable future without plans for liquidation or bankruptcy. This principle allows accountants to use historical costs when preparing financial statements, rather than basing values on potential liquidation prices. Why does this matter? It ensures consistency and reliability in financial reporting, giving investors and stakeholders confidence in the company's long-term stability. However, if there are indications that a business might not remain a going concern, such as severe financial distress, disclosure of this risk becomes essential. By adhering to this principle, businesses provide a clear and standardized picture of their financial health, helping decision-makers plan for the future effectively.
The monetary unit principle is a fundamental accounting guideline. It states that only transactions measurable in monetary terms, like dollars, euros, or rupees, are recorded. This ensures consistency and comparability in financial records. Why does it matter? Without this principle, financial statements would include non-monetary information, creating inconsistency. By focusing solely on stable currencies, businesses maintain clarity and reliability. For example, if a company receives a building as a gift, its value is recorded in monetary terms. It cannot simply be listed as a building in the financial statement. Instead, its value will be recorded as something like building 5 million rupees. This provides a clear, universal standard for accounting across businesses worldwide. The time period principle is a cornerstone of financial reporting. It states that an organization's activities can be divided into specific, consistent time periods, such as months, quarters, or years. Why does this matter? By breaking financial data into uniform periods, businesses can track performance and compare results over time. This helps stakeholders understand trends, evaluate progress, and make informed decisions. For example, if a company prepares quarterly financial reports, investors can see how profits and expenses fluctuate and spot seasonal trends. This consistency ensures comparability and transparency in financial reporting across periods. Historical cost principle is a fundamental accounting rule. It states that assets are recorded at their original purchase price rather than their current market value. Why does this matter? This approach provides objective, verifiable figures in financial records, making them reliable for users. However, it may not always reflect true market values over time, which is a limitation. For example, if a company buys a building for $1 million, the asset will remain recorded at that amount, even if its market value rises to $1.5 million. This ensures consistency, but highlights the need for supplementary information in financial statements.
Is a key accounting standard. It states that revenue is recognized when it is earned and realizable, typically when goods or services are delivered, not necessarily when cash is received. Why does this matter? This principle ensures that financial statements reflect a company's true economic activity. It prevents premature or delayed recognition of revenue, offering a more accurate depiction of financial performance. For example, if a business delivers a product in December but receives payment in January, the revenue is recorded in December. This method provides clarity and consistency in financial reporting. The matching principle is a key accounting guideline. It states that expenses should be matched to the revenues they help generate within the same accounting period. Why does this matter? This principle ensures that the reported net income reflects a company's true economic performance during a specific period. It prevents misrepresentation of profitability by aligning costs with the revenues they contribute to. For example, if a business sells a product in December, the cost of producing that product, such as materials and labor, is recorded in December as well. This consistency enhances financial accuracy and transparency.
Accounting. It states that income and expenses are recorded when they are earned or incurred, not when cash is exchanged. Why does this matter? The accrual principle ensures financial statements provide an accurate snapshot of a company's economic activities, capturing the true timing of transactions. This gives stakeholders a clearer understanding of the company's financial health. For example, if a business delivers a service in December but gets paid in January, the revenue is recorded in December. Similarly, expenses like salaries incurred in December are recorded then, even if paid in January. This method aligns economic activity with the correct reporting periods. The full disclosure principle is a vital accounting standard. It ensures that all material information, anything that could influence decisions made by users of financial statements, is disclosed. Why full disclosure? Transparency builds trust. By sharing important details, businesses minimize the risk of misleading stakeholders and empower investors, creditors, and other users to make informed decisions. For example, if a company is involved in a significant lawsuit, this information must be included in the financial statements. Failing to disclose such details could misrepresent the company's true financial health. This principle upholds fairness and transparency in reporting. The consistency principle is a key accounting standard. It states that companies should consistently apply the same accounting methods and procedures from one period to the next. Why is this important? Consistency ensures meaningful comparisons of financial statements over time, helping stakeholders identify trends and assess performance. Any changes in methods must be justified and clearly disclosed to maintain transparency. For example, if a business switches from straight line to accelerated depreciation, this change must be disclosed and explained. The consistency principle builds trust by ensuring financial reporting remains reliable and comparable. The materiality principle is a guiding concept in accounting. It states that information is considered material if its inclusion or omission in financial statements could influence users' decisions. Why materiality is the key? The principle helps accountants focus on what matters most. Trivial details can be disregarded, but significant items must be reported accurately to ensure financial statements are clear and decision-relevant. For example, an error of a few dollars in a multi-million-dollar company may be immaterial. However, a missing $500,000 transaction in the same company could mislead stakeholders and affect decision-making. The materiality principle ensures appropriate focus on impactful details. The prudence principle, also known as the conservatism principle, is a key accounting guideline. It advises accountants to err on the side of caution, avoiding overstating assets or income and not understating liabilities or expenses. Why is prudence essential? This principle ensures financial statements present a cautious and realistic view of a company's financial position, guarding against over-optimism. For example, if a company anticipates a potential lawsuit loss, it records the liability immediately. However, if there's a chance of winning a lawsuit, no revenue is recorded until it's guaranteed. The prudence principle prioritizes reliability and caution over speculation.